And we're starting the audio. The recording has started. Hello, everyone, and welcome to our next webinar session with Traders Lessons. Here today, we are going to talk about the comparison of CFD and stock trading. I hope you can see it well. Now I know it's like 1 minute before the event is starting, so just quickly, um, I'm going to tell you that today we are going to cover the topics of CFDs, stocks, indices, and currencies. We are going to talk a little bit more about them all. We're gonna try to compare them. We're gonna try to see the pros and the cons of how to use them in your investments. It's really strictly personal. If you would like to work more in the CFD field or more in the stock field or indices, basically we will try to cover most of the investment types of products, give few words about the stock and CFD market, and hopefully after our session is finished you have better idea, clearer idea of whether you would like to invest into CFD markets or stock markets, and to make let's say informed decision of where your capital should go and how you should use it. So it's about time. Let's get started. Remember, there is a chat room here down below where okay, I'll put there hi right now, so you can see the chat room below. You can see this is the channel of communication which we can use. I will start the presentation now. I will remind you all now. I see already people writing. Good. So right now, I'm going to complete the whole presentation. Afterwards, we are planning with Traders Lessons to have different packages that involve these topics with the presentation, with the live video recorded. That's why I started with the recording a little bit earlier. So you can have it for your own discretion to use it whenever you like, whenever you want to remind yourself something, or let's say you want to go and make another review of your investment opportunities. All right, so let's get started. I hope you can see the presentation comparisons of CFD and stock trading. We're going to start with the first slide, which will be our main topics, our main goals and agenda into this webinar session. Again, I want to say hi to everybody in Facebook who is watching us live right now. Uh, if you want, you can stay here with Facebook and just listen to what I'm saying. If you want to see the presentation, it's right here. It's right here on the Traders Lessons website. Live, you can see the webinar running presently on our website. So yeah, whatever you decide, you can use it both. So let's continue. The agenda for today, as we said, introduction to CFD and stock trading, pros and cons of CFD trading, pros and cons of stock trading, explanation of index trading, explanation of currency trading, and of course, explanation of commodity trading. For the last one, I'm pretty sure that most of you have tried it at least once, or if you haven't, this is usually like the first thing that people think of when they talk about investments, when they talk about trading, they go to commodities, but everything in time. So now let's continue. First, we're going to introduce you to the CFD and stock trading. Um, the difference between CFD and stock trading is the following. Leverage and margin in CFD trading. In general, CFD trading allows you for higher leverage and lower margin requirements compared to stock trading. Meaning that with CFDs, you can use the help of a trading company, of a trading broker, and you can actually trade with more capital than you have invested. In stock trading, like straight stock trading, and we're not talking here about CFD brokers that will also give you the option of stock trading with leverage. We're talking about real stock trading where whatever you buy it with your own money without any leveraged capital. So with the CFDs, contracts for difference, I would like to stress on this term, contract for difference. And this is the abbreviation of CFD. So with CFD trading, what you do is simply to work with the help of a trading company using bigger capital than what you have actually invested. In this case, as we said, lower margin or lower capital required from your side combined with the higher buying power of a company. This has its pros and cons, you'll see in a moment, but this is what it's meant under CFD trading, using your own capital multiplied by certain financial institution, financial company, trading company, whatever, to enter into the market. Ownership of the underlying asset. This is a very specific sign of stock trading. In stock trading, investors own the actual shares of a company, while in CFD trading, there is no ownership of the underlying asset. As I said already, when you trade with a trading company, you still can do shares. You can still open some positions with shares, but you do that with the leverage, with the buying power of the company, and the shares are under the form of CFD. You do not actually own the shares. While when you do real stock trading, you do it with actual ownership. If you have, let's say, 10 stocks of company X, this is your stocks. It's not the company purchasing it and you are just speculating with it. No, it's your own it's your own stock. This is why it says ownership. Cost associated with trading is the third thing that we're going to discuss. Stock trading involves additional costs such as stamp duty, while CFD trading typically has lower transaction costs. When you're actually entering in an ownership of a certain stock, there are some requirements for the ownership, like as I said here, stamp duty, so on and so forth. Some charges. If let's say you're going through the bank takes its commission before you actually buy the stock, and so on and so forth. Usually in stock trading, they go into packages, like you cannot buy less than certain amount. So yeah, the cost wise, actual stock trading can be more costly, more expensive, if you may say. So, okay, we have another person that just joined. Hello. Hi. Okay, let me again share the full screen so we can continue. Differences between CFD and stock trading. We're going to continue with liquidity and ownership. I've just started with the ownership. We're going to continue to this topic. In stock trading, investors own shares of the company, while in CFD trading, there is no ownership, as it is a derivative product with no physical ownership to the underlying asset. Exactly. This is also something that is connected to the liquidity. When you do this with the help of a broker, in this way, basically all the time while the market for a specific stock is open, you can actually close your trade. You can end the deal. Let's put it this way. While when you have the ownership, there are certain hours when you can actually open or close a deal. Regulation and transparency. Stock trading, in the other side, is often more regulated and transparent compared to CFD trading. As I told you already, when you do CFD trading, you do this usually with the help of a forex broker or trading broker or some kind of an investment entity. And sometimes the regulations there, since basically regulations all over the world under trading brokers and trading firms is different. So sometimes the regulations for CFD brokers can be less strict, let's say, than regulation of stockbrokers and buying stocks directly from a bank. Okay, so these different regulatory bodies can actually give different requirements for the products to be operated and the clients to work with on the market, which can be good or bad. This is something that you decide, because when it comes to purchasing something live, again, more documentation can be required and more requirements need to be fulfilled due to the stricter regulations. And dividend and voting rights. Stock trading provides access to dividends and voting rights, whereas CFD trading does not offer these benefits, as it is based on price speculation, I mentioned this already, rather than ownership. So as we said, if you're looking for the pure profit of just predicting price movement on a specific stock, as I said, company X is about to enter in the market, or they're about to go get a new product, and you know that the price of this company's stocks will go up. If you're looking for the pure speculation, just making some money out of the jump, you might take a look into brokerage, CFD broker, that can help you open position with these stocks. If you're actually looking for particular ownership participating into the ventures of this company. We're going to put it this way. In this case, stock trading, like real stock trading, can be something for you, because in this case things are moving slowly. It doesn't matter if right now there will be a boom on the stocks or not. You just hold them for a longer run, just because of the ownership that we just described. Okay, let's continue. Pros and cons of CFD trading. When we talk about CFD trading, the pros are the following. Leverage for potential higher returns. CFD trading allows for leveraging, which can result in higher potential returns of investment. Meaning, when you're working with the buying power of a trading company, you, for every dollar that you invest, you get, let's say, $10 more, 20, 30, 200, 500, depending on the actual leverage of the company. So the multiplication of your own capital can be way higher. This gives you the power to open bigger trades, to buy more from a specific product on the spot with the company. And actually this can result, as we said here, in a higher potential return, because it's one thing, let's say, if you buy one stock or 1 ounce of gold and try to make money out of the jump of the price from this 1 ounce, from this one unit of a product. It's different if you have a buying power from a trading company, and instead of one, with your own capital, the same capital, you can buy, let's say, 10 or 200 more or 500 more of this. Obviously, pure math says that if you buy 1 unit of a product and the price goes up with $10, you're making 1 times 10. If you buy 500 or 200 from this product and the price goes up again with $10, you gain 200 times 10, or 500 by 10, which you can all do the math yourself. So yes, with leveraged products, with CFDs, the amount that you can buy with your own capital, the same capital that you can afford, can be higher, and the potential profit can be higher. Diverse range of markets. Again, something interesting when it comes to CFD trading. With stock trading, you have 1, 2, 3 companies you can go with, you buy with them, and that's it. You're locked. This is the only thing you count on. Earning reports or announcements of new products, something like that, or just pure speculation that the company is doing well. While with CFD trading, it offers access to various markets, including stocks, indices, commodities, currencies, and crypto, ETFs, and so on and so forth. I haven't listed them all here. And it is providing diverse trading opportunities. In this situation, in our previous webinar session, we discussed diversification as trading strategy. We're going to talk further more into it. Diversification is one of the most popular things that investors and traders use in order for them to limit their risks, to balance their risks. So yes, with CFD trading, you can reach this diversification. On stock trading, there is a possibility, but not that strong. So ability to go long or short is the third thing as pros that we have listed here. What do I mean? Long or short are technical terms for buy and sell. Going long means we're buying and we're expecting the price to go further up. Going short means we are selling and we're expecting the price to collapse, to drop down. Both ways, when it comes to CFD trading, you can actually make profit. CFD trading allows traders to profit from both rising and falling markets, offering flexibility in trading strategies. Meaning, if right now you expect the price of a certain product to drop, if you do stock trading and you want to buy stock, the only thing you can do is to buy it, and if it goes further down, you're not gaining anything, you're just waiting. If on the other hand you go with the CFD trading, on this particular situation, you can open short trade, sell trades, or you go short on the product and you gain profit while the price is dropping. In a few of our last sessions, we were discussing exactly the idea and the possibility of you making money while the price is dropping through CFD trading, through speculation. Cons of CFD trading: risk of high leverage leading to losses. The use of leverage in CFD trading can amplify losses, leading to significant financial risk for traders. Meaning that this multiplication that I just told you about in our previous slide, when you open, instead of one, you open 500 from the same product. In this situation, as you can gain 500 times more or 200 times more, the same with the same strength, with the same power, you can lose 500 or 200 times more. This goes both ways. Whenever we're targeting higher profit and we are using the buying power of a company with our own capital, there is also risk of things going sideways, going against us. Potential for over trading. CFD trading may lead to over trading due to easy access and the ability to trade on margin, potentially causing impulsive decisions, emotions, and over trading. You know you can afford to work with 200 times more than your money, with 1,000 times than your money you actually invested, and you're getting excited. It's human nature to get excited, to get too much into it because you think now I have the money, now I'll do it. I had, let's say, only $10,000 ahead with me, but now with this 10,000 I can go for 200,000 investments. It's great. In theory it's great. If you apply a proper strategy into it, it can be even extremely beneficial. But if you apply only impulse and emotion to it, it might result into a loss. So, costs associated with overnight financing. CFD trading may involve additional costs in the form of overnight financing charges, overnight fees, swaps, rollovers, whatever you call it. All these terms result in one thing. Every day when trading market is closed, let's say you are trading in the US session, but the US session is closing. If you don't close your trade, if you don't close your investment at the end of the market, it's being transferred to the next day. But this transferring costs this overnight fee that we've mentioned on our slide. Okay, let's continue. Pros and cons of stock trading. I'm trying to touch both the products in the same time in order for the comparison to keep on going. But of course, in our slides, we're going to keep on stopping on every single topic. All right, let's continue. Pros of stock trading. Ownership of the underlying asset. In stock trading, investors own the actual shares of a company, while in CFD trading, there is no ownership of the underlying asset. So if you're looking for ownership and something to buy and just hold it for a couple of years, maybe, stock trading can be your thing. Using only your own capital. Trading with stocks involves solely your own capital without any leverage and bonuses from the brokerage side. In this case, again, if people are interested mostly into using only their own capital and they're afraid of this over trading that I just mentioned in our previous slide, in this case, yes, stock trading can be something that you would like. And long-term investment, again, connected to the previous two parts, there is no expiry date in stocks. And with some of the CFDs are. That's why it's called CFD, contract for difference. So since there is no contract here, there is no expiry date here. You can hold this stock that you own as long as you like. Cons of stock trading: lower buying power. So the same way you're working only with your own capital when it comes to stock trading, the same way you cannot simply go with huge amounts. You cannot go with a bigger portion. So even with smaller price movement for you to gain something good out of it, because without leverage you can buy only what you can afford with your own capital, which can result on low gains even in high market movements. Again, I will refer to the example. One unit you buy, or let's say with your own money you can buy 5 units from a product, from stock or whatever. In this case, if the price goes 10 or 20 points up, you make 5 by 10, 5 by 20. With the leverage, with the same money, you buy instead of 500. And obviously, the multiplication will be different. The result will be different. No daily trading. Trading stocks usually takes time and patience to wait for a good potential jump in price. You cannot make sufficient day-to-day profits. If you're looking, as I told you, just to take your money, put it somewhere, forget about it, you can consider the stock trading. On the other side, if this is not for you, you want to do day-to-day profiting, well, in this case, stock trading may not be your thing. And lack of diversification. If you trade solely stocks, you are exposed to good and bad only from the one trading market during specific trading hours of the day. There is no option to cover potential losses in the day. Just what I told you before. When you diversify, even if a product is not working well for you, you have something else that might cover it. But when you are locked into a specific market, to a specific trading hour, there is no moving. There is no backup plan. Let's put it this way. You suffer the goods and the bads. Okay, we'll continue with index trading. Explanation of index trading. Composition and calculation of indices. What is an index in general? Indices are composed of a basket of stocks and are calculated using different methodologies such as pre-weighted or market cap weighted categories. With simple words, when you have an index, it's usually giving you the top 10, top 20, top 100, top 500 companies in a country. These top companies, these high class companies, like usually the ones that are with the bigger market capitalization or market weight, like which companies their shares are costing more, we can put it even this way. So these companies that are more strong in the country, they form the index of the country, because the general idea is these are the companies that produce more for the country and they are helping the country develop. It's helping the gross domestic product of the country grow. So these big companies are taken all under one roof, they are combined, and this is the index of the country, showing whether the country is producing more or less, if the country is moving good or bad, we can put it this way. So diversification and risk management in index trading. Index trading allows for diversification across multiple stocks, adding in risk management for investors. What do I mean? When you go, let's say, with stocks of 2 3 companies, it's one thing. But if you have all of them combined, let's say the 500 biggest companies in UK or in Germany or in United States or whatever, if you have them all, even if 2 or 3 of them are not performing, the others can actually perform well and bring up the price still, regardless that these 2 3 are not performing. So in this case, you're not limited and you're covered um, to have let's say potential movement in your direction, regardless that not all of the products in the index are performing well. Tracking benchmark performance in index trading. Investors use index trading to track the performance of a specific market segment or the overall market. Meaning that when you are investing, what you can do is simply to track how the economy of a country is moving, how specific companies in the country are moving, and in this case, after you do all this, you track and you see the results, you can easily enter in the index and use all the information you got to um, take better decision whether it's right now time to go long or short in this index. Market sentiment and economic indicators in the index trading. Index trading reflects market sentiment and can be influenced by economic indicators and geopolitical events. The interesting thing about an index, which is already, as we said already, representing the economy of a specific country, can be influenced from the markets, meaning from the prices of the company's shares in this index, but it can also be influenced from the geopolitical trends, from the geopolitical events all over the world. These geopolitical events can result an index of a country to drop, regardless that in general there is no specific drop in the income of the companies that form the index. Simply, the belief into this country's economy is dropping, or rise, on the other hand, without any specific reason, any specific income for the companies. So this is something also that you need to pay attention when it comes to indices, that they move not only based on the price of the stocks of the companies involved into it, but also they are moving from the news. They're moving from events connected to this specific country that you have chosen, the index of the country. Explanation of currency trading. High liquidity and trading volume in currency trading. Currency trading offers high liquidity and significant trading volume, providing ample trading opportunities. If I have to elaborate on that one. When you trade currencies, usually you do it in currency pairs, meaning that you're covered from more markets, many markets that are exchanging those currencies, and the volume there is higher. Higher volume in the trading markets means more volatility, like more chances of you to catch an opportunity. That's why we're talking here about ample trading opportunities. Now, 24-hour market in currency trading. I told you already, the currency market operates 24 hours a day, allowing for flexibility in trading timelines. And it is like that because every single country all over the world, every trading session has its own currency exchange involved into it. Exchange rate fluctuations in currency trading, exchange rate movements in currency trading can result in substantial profit or loss potentially. What do I mean? I mean that when it comes to exchange rate, during the European session, let's say the European session of the trading market, the euro is moving well because there is a lot of exchange for euro, banks are opening, so on and so forth. When the European session closes and we have the US session opening, then we go and we take boost from the dollar. In this case, you can see volatility, the euro dollar going back and so on and so forth, or the euro yen slowing down, but the dollar yen increasing and so on and so forth. This is the fluctuation that can be covered from all these markets. And leverage and risk in currency trading. Usually, by the way, most of the forex brokers, most of the CFD brokers are providing higher leverage for currency pairs. So here you can like go with the highest amounts. You can go wild with it. Leverage in currency trading can amplify both potential gains and losses, posing a risk to the traders. But as you agreed already in our previous slides, it's part of the game. If you want to gain more, you are entering with bigger risk or bigger capital. Explanation of commodity trading is the next step we're going to take. As I said, commodity trading is like the most popular one usually. Like everybody have heard about crude oil, gold, silver, platinum, palladium, whatever you think of right now. Cocoa, actually, cocoa presently is like a crazy product to work with on the markets. We don't know for how long yet because it's pure speculation there already. So yes, explanation of commodity trading. Types of commodities in commodity trading. Commodity trading includes agricultural products, energy resources, metals, and other raw materials. Everything you can think of. Corn, coffee, coal, copper, zinc, platinum, platinum, oats, aluminium, cocoa, coffee, cotton, everything like on these particular ones, everything. Supply and demand dynamics in the commodity trading. Commodity trading is the market participation engaged in is engaged in speculation for potential profits and hedging to manage price risk in commodity trading. In this particular type of trading, commodity trading, you are mostly focused into supply and demand. When there is huge supply and no demand, the price of a commodity will drop. When, on the other hand, we have no supply but the demand is stable or even increasing, you can see a spike into the price of a product, just like we saw with coffee, with cocoa lately, and with gold, by the way. So, physical delivery and futures contracts in commodity trading. Commodity trading involves both physical delivery of the underlying asset and trading future contracts. When you do this with the help of a CFD broker, contract for difference, CFD broker, you are working in the contracts part of it. You don't actually own the product, but you speculate with its price. In this way, usually you can buy way more. When you're doing it without leverage, many people actually tend to do it without leverage by simply buying investment gold, physical gold or investment gold, it's called, or investment silver. These are two of the products that can be even physically owned, and for you just to wait for the price to go up. In this way, you are speculating in a way, but you're not using leverage. You're working with your own capital, and you're using this investment commodity. Speculation and hedging in commodity trading. Market participants engage in speculation for potential profits and hedging. I've mentioned all this already because when it comes to commodity trading, you can hedge, or if I have to bring another term into it, you can diversify and cover your risk by, let's say, going long on gold but going short on silver. They usually move pretty much the same, but if one of them you count on the downside and one on the upside, whatever happens to them, at least one of them will be on profit. But this particular hedging strategy, like many others, we're going to go further into on our next training sessions. But in the end of the day, it really depends on how you're placing yourself into the market with these strategies and what kind of amounts you're using for that. Okay, let's continue a little bit more about exploring of the commodity trading strategies. Technical analysis. Traders often use technical analysis to predict price movements based on historical data and chart patterns in the commodity market. In quiet market, when there are no threats of war, there are no threats of scarcity of certain product. In this case, yes, you can believe the technical analysis. Commodities tend to move very good on charts and technical analysis. But there are times in which the technicals are no longer valid with commodities and we go to fundamental analysis. Fundamental analysis involves assessing supply and demand fundamentals, geopolitical factors, and macroeconomic trends to make trading decisions. Something that is happening recently, trading the news. This is what's happening lately. The gold is not over if we have to talk about gold. We still have gold. But right now, there are two levels of tension in the world. I'm pretty sure all of you know about it. I'm not planning to go into politics and to analyze is it good, is it bad, how bad it is, or whatever. But the main point here is this, that the fear and the news right now are controlling the price of commodities like gold, like silver, like crude oil, because they are the so-called safe havens. Everybody is just trying to switch their money there when they don't believe in the economy is moving upwards. So in this case, you switch from technical to fundamental. You switch from trading the charts and the regular patterns in the movement, and you go for supply and demand and fear from the news. Hedging and speculation. Commodity trading allows for both hedging against price risk and speculation on future price movements, providing flexibility for different trading strategies. I told you already, to hedge mean to, let's say, to go two products moving almost the same, to go with one position that it will go down, one position it will go up, and so on and so forth, like covering similar products but on different direction. Also, there are many other trading strategies that, as I said, we can discuss in our next training sessions, in our webinars, or one-to-one educations that we do in traders lessons with our professional trainers, people like me. Seasonal trends in the trading of the commodities. As I told you, some of the commodities are agricultural based, like corn, coffee, cotton, oats, wheat, so on. So certain commodities exhibit seasonal price patterns, and traders may capitalize on these trends by adjusting their trading strategies accordingly. Meaning, when we are far of harvesting season, this means that there is scarcity of wheat, let's say, and the price might go up. When the harvesting season comes, and actually you know and you see reports that there will be a good harvest for this year, there will be a good amount of a product after its season. This will surely increase the supply, and if the demand stays the same, the price might drop. I told you already in the beginning when we were doing when we were doing the explanation of commodity trading that is strictly based at a certain level on supply and demand. When we have lack of supply and regular demand or increasing demand, we have a jump in the price. If we have huge supply but no changes in demand or even drops in demand, we can have a drop down on this product. Changes of commodity trade, challenges of commodity trading. Price volatility is the first challenge that you might face. Commodities tend to be extremely volatile. We've seen it with many products lately. I already mentioned few of them, like the most famous: gold, crude oil, silver, coffee, cocoa lately. Wheat actually was extremely volatile when 2 years ago, when first things between Ukraine and Russia started. So yes, price volatility can be a huge challenge for traders. You need to be very careful to manage your risk right when it comes to price volatility. This, of course, can help you even gain, but it depends on your strategy and, of course, in your attention, if you're paying attention to what's going on. Geopolitical factors is, again, something I just said, especially right now with this situation all over the world. We have many trading opportunities, but many problems at the same time. Supply chain disruption. Disruption in the supply chain due to the natural disasters, transportation issues, or geopolitical tension can affect commodity availability and prices. I already said it a moment ago, but it is connected to everything all over the world. Everything all over the world, like there was and there is still a situation in Red Sea right now. Shipments are getting late, so on and so forth. All these things can influence the price movement. If you are aware of it, or if you're not, and you're counting to the help of a professional that is monitoring and working together with you with all the news, you can easily take advantage of all those disruptions. And regulatory changes. Changes in regulation related to commodity trading, including policies on traffic, exports, environmental standards, can impact market dynamics. The recent example that it comes to my mind right now is copper. I'm not sure how much of you know, but lately we had a situation where the European Union is not using copper delivery from Russia anymore. Magically, Russia didn't fall out of its, let's say, it didn't flood with copper. Let's put it this way. It didn't fall out of the copper market. Exactly the opposite. They even increased their production on a certain level, which was a very interesting fact until it was discovered that China is buying more from them and they're disguising it, they're covering it. It's like they're buying trash. They're buying only waste, copper waste, but it was the actual product. They just found a way to go around the regulations. So those kind of regulations that happened recently are a very good example how the price of a product like the copper can suffer a lot or can jump a lot. If right now everybody needs copper, but they're not buying from one of the bigger producers, so in this way, in pure logic, the supply is dropping, but the demand stays the same. All right. This is for today, for our session today. I hope we've been of help. I hope that you have seen us on our channels of communication, Telegram, YouTube, Facebook, webinars on our website, and everything else. If you're not, try to catch up with us. We have a lot of videos on YouTube that you can watch on different topics along with this topic. We can help you with personal touch, with personal we can help you with the personal touch. We can help you with a lot more of our knowledge, and we would really love to hear out from you, to hear comments, to hear anything that you would like to share with us. As I said, we have many channels of communication. We have the Facebook channel, we have the YouTube channel, Telegram, basically everywhere you can contact us. Link and as I said already, this particular session that we had right now, along with many others, soon enough, I hope we are developing this idea for quite a while now. Soon enough, you'll be able to have it in packages, so you can actually read the presentation yourself whenever you want, and also watch this webinar again. It's recorded. I'm recording it right now, so I'm pretty sure that you would have the interest about it. Now, the topics might not change. Still, things are changing all over the time. The CFD and the commodity trading that I mentioned earlier is something that for sure will be influenced from the world situation soon enough. So I suppose, very soon we're going to have another session on similarly the same topic, but with the newest updates on the markets movement. All right. Um, I'm giving here a few moments. If somebody wants to ask a question in the chat, just write. I see here people writing hello, hi, everyone. I'm gonna mute myself, not to distract you. Just gather your thoughts. If you have a question, write it in the chat. I will be more than happy to answer it. Okay. First question here is whether you should choose index trading or commodity trading as a beginner trader. Now, indices, as I mentioned in the presentation, they are complex products, meaning they're combining the shares of companies under one country and under one symbol, under one index, as we said. If, let's say, right now you're just stepping into it, into the trading world, probably it will be more difficult for you to track down the movements of these companies' shares and the general performance of country's economy. But if you go to commodity trading, news for commodities, especially major commodities, is something way more accessible. You can hear it every day, everywhere. So yeah, if you are a beginner and you just want to learn the dynamics of it at first, maybe you can check first the commodity trading, do things that you already know and you have some expectations out of, and then you can continue further. I hope I managed to answer it pretty well. Anything else as a question if you have, I'll be more than happy to answer. Okay, two questions I have already. Now, how much do I need to start trading? This really depends on what are you targeting as initial trading experience. If you want to go on one, two products on the market, or you want to cover it all, so it is connected to your own capital and it is connected to the leverage of the company that you're working with. Usually, people tend to start with, let's say, 200, $500,000 just to test the water, try, as I answered in the previous question, few products like one commodity, one currency maybe, or one index. And yes, regular trading capital in the beginning, something like that. And many companies have their own minimum for it, of course. But yes, if you do have that kind of capital from 200 to $1,000 in the beginning, especially if you're a beginner trader, is something that will let you test the water, but not get too much into risk in the same time. Another question: if I can recommend a company in South Africa. Well, we do work with many companies all over the world. You can see more about it on our website. So what I can say is that if you're searching company in a specific country, you can just check if this particular company is locally regulated, if it's working under the regulation of the country, or at least if it has an international license that is credible. We can put it this way. But yes, a recommendation. You can check on our websites. Even we have one-on-one sessions with our professionals that can cover with you a couple of companies, and you can simply choose one of those. All right. Any other questions if you might have? It's my gosh, today we're going more extent into the session, which is great. Okay, thank you, thank you. I see people writing, that's why I'm saying thank you. How can I continue with the lessons? Another good question. As I said, on our website, there are different packages that you can check and to see if you want to have one, two sessions, one-on-one group sessions, another webinar sessions. Basically, all the website is designed to cover all your needs. If you want to continue with your lessons with us, there are different packages that you can choose from, and you can easily take advantage of our program of studying and learning together and discovering the trading world together. Okay, thank you really for today's session. Thank you for being part of our community, of trying to work with us onto the trading world. I really appreciate everybody who is our followers in Facebook on YouTube. Again, stay posted. We are trying to be helpful. We're trying to be more involved into any single topic that is out there. And we're going to keep on doing these sessions, keep on pushing forward for people to know more about trading, learn more about trading, and of course, achieve profiting from knowledge and experience. Again, thank you all for attending this webinar session, and I hope to see you all next time on our next most interesting topic, I may say. Okay, one more question. When is the next webinar? All right, I said it in the previous sessions. I'll say it now again. Every Thursday, same time, just like now, which is 4 p.m. GMT plus 3, or it should be like 1 p.m. GMT, if I'm not mistaken. Every single Thursday, we're trying to have at least one session going live on Facebook. Right now, I'm giving shout out to the people in Facebook going live here into the website. So every Thursday, we have our session and stay posted. We are trying to make this as popular as possible, meaning we are posting in all our channels of communication links to this training session. So yeah, I hope you won't miss it. Again, thank you and hope to see you all next time. Bye bye.